that appeared to be messing with my internet. So I went to a remote location. Imran has a voice problem, but we're off into the races here now for June OPEX. It's amazing that 2023 is already half over. So Imran, how are you doing?
Good to see you, man.
Yeah, it's great to see you. I'm like all kind of discombobulated here with the connectivity stuff. You think by this point I have it all ironed out, but at any rate, we're live here and there's just a lot going on, right? Market's kind of off a little bit to the races here today. Yesterday it moved quite a bit. The June options expiration is a very big expiration. We got the buyback blackout happening on the 15th. We got the FOMC tomorrow. We had the CPI reading coming today. Looks like it was a little bit, I guess I'd say benign CPI reading today, right? So markets caught a little bit of a bid off of that. So we're going to dig into all of those things today. Dan Harrison says it is Jesus. I think he's referring to me and not you. Maybe he's referring to you. I don't know. But I guess I do have a little bit of that.
I'm pretty sure it's you.
Listen to me, my children. That's what I'll have to say. Anyway. Yeah, so let's start with just sort of what the framing of the market was today, given the CPI, and you cover the macro side a little bit more than I do. What did you take away from today's CPI reading? Does it change what you think the Fed is going to do? Kind of set up the stage here for us as we move forward into tomorrow's Fed Day FOMC.
I mean, look, it was already mainly priced that they're not going to hike tomorrow. This has just kind of confirmed that for the market, right? So I think the pricing dropped to 0%. It was like 20-25% probability.
Yeah.
This has given them the cover to pause. What has it done to the July? The July hike is still live. I don't know if you use that Fed Watch tool. We can see on there what the July pricing is now. It was pricing in a reasonable chance. Well, it's pricing in 50% chance of it's now a 60% chance of 25 bips, is it? Or is it actually staying the same, actually? It's a 50% chance of staying the same. So that's interesting because it was pricing a 50% chance of hiking in July. But now I think that pricing is coming out a little bit, right? So where are we? Do you see that? Do you want to bring that up on the screen?
Yeah, I can grab that link real quick.
It's just it'd be useful for the viewers, right?
Yep.
But I mean, the market is pretty confident that they're not moving tomorrow, right? 92.
And I think a lot of the conversations then switch around to, what is from my lens sitting here with the FOMC rate tool, as you can see here is pretty much, as you were mentioning, the consensus is very strong as to what's going to happen at this point. And I think from my perspective is though, the inflation is coming down, but how much is that worth to the market to kind of front run at this point, right? It seems like kind of tech in particular caught an extra bid, I think, off the fact that it sort of solidifies that there's not going to be a hike at this point. And so how much of this is already being kind of priced in if you have this, consensus position at this point?
Yeah, well, exactly. You shouldn't really need to squeeze that much because the market wasn't really looking for a hike this time round. But, you look at what yields did. Intraday yields reverse, right? So yields dropped initially about 7 or 8 basis points, and they've actually turned back the other way and gone higher. So actually going to the July meeting, which is more important, is actually pricing 60% chance they hike 25. That's actually gone up from 50. So that's interesting. So the fact that the market's rallying in the face of a rates market that is actually adding probability to a July hike is somewhat surprising, right? I don't know, the market just wants to rally right now. I don't think you need to be too scientific about it. It's like, I think the 4,300 area we thought was going to be a bit of a cap, especially 43.20 because of that big end of June option, the JP. But as we blasted through that, I was saying this a couple of weeks ago that I think a lot of clients have bought really low delta upside, 4,400 and above, because they're not worth anything, right? They're so damn cheap. The vols were so low. That was a way to own some upside convexity for pretty much free. And I actually think on this rally, the street has got taken out of its gamma much faster than would normally happen. So normally, you know, we make the assumption that all of the open interest on the upside on index is street long, client
Right.
short. That only makes sense up to a point where those shorts are worth selling, right? When those shorts don't give you any premium, if there's a ton of open interest on them, clients are better off being buyers of those than sellers of those, right? So I actually think that's what's happening. And that's somewhat backed up by what we saw in vols yesterday, where VIX was higher with the market. What's the VIX spot doing today? Let me have a look.
Yeah. So to your point on the vol issue, I guess the VIX is, you know, that 14-ish area, and you have the higher implied volatility currently versus a week ago, which is what you're seeing here from the kind of money risk perspective or at the money perspective, and that's obviously due to CPI and the FOMC. But when you look at it on this fixed strike perspective, this is from our note this morning. What you see is on a week over week basis, and this is 1 month fixed strike vol. You can see there is this bid. You can see there's this kind of like bowed, right, formation, I guess I call it, to fixed strike vol, which, you know, tells us, or sort of backs that point, right, that there is this bid to these upside strikes, and that people just want to get long this market. And, you know, the higher it goes, the more you could argue that there is this chase, right, that you know, you can't afford to fall behind if you're a manager at this point. And so, you know, dips are getting bought, or the assets that are kind of weaker, like it was AI, and now it's small cap rallying, right? And so I think, you know, you're getting this kind of rising tide where I noticed you've been talking about correlation a little bit recently, and I think we'll start to get more of a highly correlated market rally, you know, in kind of the medium term, I would say.
Yeah, so the correlation point that I made last week was that correlation was crashing, right? And that was because there was a bit of an unwind going on between people who've been long tech and short, you know, the banks and the mid caps and the value type stuff. That had been the trade that worked really well. That it seemed like that was somewhat getting unwound last week when the Russell was up and the Nasdaq was down. But that didn't last very long. And now we've had just a bit of a broad-based rally again. Nasdaq keeps charging. But you know, really for me, it's just indicative of the idea that we're not on the upside. We're normally used to dealers being long gamma and markets not really realizing on the upside, right? But you get pockets in time where the conditions change. And what happens is you see skew flatten dramatically, like we have seen, right? After the debt ceiling, skew absolutely collapsed. You see the absolute levels of vol get annihilated, and then you see a breakout in the market, and now all the clients have piled into those upside calls. And what I think's happening is dealers are running away from their gamma. So dealers are long gamma from, let's say, 4,300 down to 4,150, but they're not as long gamma above 4,350. So you know how often on the downside we get the destabilizing fact that, oh, dealers aren't long gamma anymore, so markets can move more. I think we're starting to see that on the upside now. Above, if we get to 4,400, I think there is a constant supply that comes and it gets replenished. But just in the immediate term, it seems that dealers haven't got as much gamma as they used to have, and that's why we're seeing, you know, a bit more movement than we typically see on the upside.
You know, and I wonder too, I mean, because the rally's been concentrated in specific stocks, right? And you could say, I'm better off buying Apple and Microsoft or Nvidia calls or AMD calls or whatever, and not necessarily the broader based index, you know, position. And so I wonder if the kind of like negative gamma in those single stocks is just so much stronger that it kind of pushes the market higher, right? There's that, you know, almost like this beta drag that happens. And also to your point on the lower upside strikes, this is gamma by strike here, and this is 435 in the spiders, but up over 440 or 4,400 in the S&P, you know, there's just not much there. There's not a whole lot of positioning there. So you could end up, I suppose, with this position heading into June OPEX here, where we're about to lose about half of this total gamma position. That should free some movement up, I suppose, but we're getting, to your point, a fair amount of realized vol over these last few sessions. And so is this going to be kind of just indicative of the chase? In other words, we're going to come out of June OPEX just with new positions, you know, getting rolled higher. And if it is predominantly negative gamma in some of these ETFs, then you're just going to see a bid to the market because those dealers have to chase higher.
Mm. Yeah, I mean, sentiment has definitely turned a bit, right? We're back into greed territory now, right? And everyone's chasing it.
Yeah.
So generally, I don't like chasing it when markets do this, right? But that's not to say it can't squeeze another few percent before it rolls over. You just don't know. But I don't think vols. I don't think fixed right vol looks expensive on a 10 handle, right? Like it's an okay thing to have.
No, it seems cheap, and I think that's a little bit of the kind of conundrum here is that if the Fed comes out and just kind of gives the market a free pass tomorrow, you could end up in this situation where, because vol works both ways, right? If you're pricing in a 10 vol, that's like a 50 basis point move in the market. We could easily break that to the upside. And I actually think that may be sort of what happened yesterday as we exploded higher, kind of also just, broke higher around 3 o'clock in the afternoon. And I think a lot of that was just the market, priced in for this very, very sleepy Monday. We saw a big zero DTE flow come in. And then, before you know it, we're up, almost 1% yesterday, right?
Yeah. And the
So
zero
this is kind of
DTE,
this whole move here.
the zero DTE does muddy the water, obviously, because that gives you intraday ammunition for a move, and then it kind of mean reverts back towards the end of the day, right? So, but that doesn't mean
Yeah.
it can't push it a bit during the day.
And it makes things, quite cloudy in terms of, trying to bring up correlations over time and trying to assess really, what's happening. And we've done some initial studies on this and sort of like, what does the market do, into and out of these big options expirations? And what's interesting about it is that there seems to be a change in the way that the market behaves after OPEX. So historically what happens, and we're going to present some data on this tomorrow, but historically what happens is the market, if we have a weakness into options expiration, the market tends to rally after. And on the opposite side, if the market rallies into OPEX, we tend to have some weakness, after. So you have this flipping mechanism, right, where the OPEX is this pivot point. If you look at, and you could strike it at September of last year, and that's when zero DT became official. If you strike it in September, what actually tends to happen now is the market trades the same way through that OPEX. And it's a real shift in behavior. It's really, quite interesting. The problem is you can't necessarily pin it just on zero DTE because we had all this kind of rate volatility and suddenly the VIX expirations are by and large falling before S&P or before the equity options expiration. So there's a lot of different factors in here that to kind of like wade through. But whatever it is, the behavior of the market really from September in terms of options expiration behavior, in terms of September to today, has really changed. And as you're looking on your screen here, you can see that, we're just getting a bid to the market here. Blue line is the zero DT flow in the S&P 500. The teal line, I guess, called, and purple is all expiration. And so what's interesting on this chart here is that there is a bigger bid, or there's more long deltas tied right now to longer dated expirations by a fair margin over zero DTE. So through this lens, you could almost say, look, that this CPI reading seems to have some more bulls out there, right? There's some longer dated call flow coming in.
Mm-hmm.
And if we kind of flip, if we flip back to yesterday here, that's what I was trying to get to get to your point here. You could see it's right here, and this is the overnight flow, which is why it's flat. But you can see right here that zero DTE flow in particular, this blue line just launched right around 2:30, 3 o'clock in the afternoon. This bid just came into the market. Along with this big zero DT flow, right? And, they would say maybe it's short covering ahead of the CPI or whatever it may be. But just as we had that big zero DT flow, it seems like right now we're kind of, moving back into that as well, right? So this goes back to the original point. There's a bid in the market. And as long as Powell essentially just doesn't really nuke the whole the whole thing with, a really kind of hawkish sentiment, it is hard to feel like we're just not going to go higher.
Yeah, I mean, exactly. I think he's got to come out very hawkish to rock this market right now because it just wants to rally on anything. Give it anything and it rallies, right? It's just like there's nothing you can say to this market to make it go down right now. So, I think people who've been long and riding this are having a great time. Yeah.
Yeah, and some of these things, when you look at like Nvidia, for example, I think its price to sales is like, I forget what it is. It's like a 35 or 40. It's something absurd, right?
Yeah.
It's higher than the biggest bubble stocks of the .com era, and it doesn't matter because the narratives in this market don't really seem. Narratives is what's driving, right? Not fundamentals in a lot of these things.
Yeah.
This stock has had an amazing run. For example, they have insiders are selling it. You look at SMC, insiders are selling it. It doesn't matter, right? The bid is there. To your point, this is the story stock.
It's going to end in tears, but you just don't know if it's going to end in tears from here or from 500 first, right?
Yeah. Yeah, I mean, it's a great point. I mean, these conditions can last a lot longer, I think, than people are willing to. I forget what that famous saying is, but
the market can stay rational longer than you can stay.
Thank you, rationality. That's the one I was looking for. Thank you. Yeah. The other thing that I thought was kind of interesting is, and we touched on this a few times here, that we had the AI story and the concentration, rally there. But then the narrative kind of very quickly shifted to small caps, right? And they also caught the bid. And if you look at call skew in IWM, it's been bid way up, right? There is almost like a meme-like quality to the demand for calls in the upside in small caps. And that's really been very interesting. And actually, one of the things that I find interesting about IWM, if you look at the amount of gamma and delta that's expiring for Friday, it's actually quite small relative to the NASDAQ in the queue. So whereas a lot of the other single stocks and indices have just massive expiration for Friday, IWM seems to be a longer term story that people are positioning for. And you have this call skew, which suggests that there is this extra long bid there. How do you feel about that sort of, again, this rotation out of
I mean, I've noticed
some of these more expensive AI names?
It hasn't got, as in the 25 delta skew it hasn't inverted completely. I don't think. I just think it's compressed quite low.
It has not inverted completely.
Yeah, so it's in the low. It's at the lows, sub 2 vols or whatever on my dashboard. It shows like 1 point something. Yeah, I mean, clearly people are thinking, well, it's lagged. It hasn't participated in the rally. That's where the value is, and it's like, how much higher do you want to bid this tech stuff? So but it's also geared to the real economy, right? So the idea is, if we do have a more resilient US economy than we first thought, and the jobs data suggests we do, then these names can recover. And if we don't have a banking crisis around the corner, the banks have been beaten up, right? The regional banks. So it's more of a mean reversion story because it's been beaten up so bad. The breadth has been so poor. It's been like 5 to 10 names that rallied and nothing else has. So it's kind of the risk appetite when it returns. It doesn't want to chase the stuff that everyone's already long and has performed like 50%. Right. Chase the stuff that has still got value in it. So that it makes sense they're chasing that stuff. But, I guess the big question is, what would you rather fade when the time comes to actually fade the market? Would you rather fade the weak stuff like Russell, like regional banks, once they've had their mean reversion type move, but are still clearly in a troubled state? Or do you want to fade the stuff that has gone parabolic, right?
And I've been in the latter camp in terms of, if I wanted to fade this, and this was like a Twitter conversation we had, or a poll I think we put out, I would want to own the strength, right? But some of that stuff has now gotten, I think kind of what you're getting at here, has gotten so bid up, right? That you have to believe that the NVIDIAs of the world are going to have kind of just a lot more mean reversion if we do pull down, right? Just because they're very rich on what it seems like in a lot of different metrics.
Yeah, but whilst I agree that yes, they do look too frothy and they should pull back, and this might be their last little push before some sort of material pullback, you're still a dip buyer on the longer term on this stuff, right? Whereas on the regional banks and on the Russell, I'm not sure you are a dip buyer, right? If anything, you're a squeeze seller on that stuff, right? So you're like, let it squeeze, and I'm licking my lips ready to smash it. Whereas on the tech stuff, I'm a bit scared to short it. I wouldn't buy it here, but in a correction, everyone's going to be a buyer, right? I think that's going to remain the case.
And that, and I think that brings, circles us back to what I think the key takeaway for me is out of this is that, when you look at all these different names, they have really large call positions expiring, almost across the board in the Apples and Nvidias, and that shouldn't be surprising to anybody. And I don't think that's necessarily news. And for that reason, I think what you're looking at when you look at the expirations like we have Nvidia here, these orange bars are all call positions, and I think that these names by and large have been they ramped and then they pinned, right? Like 400 is a level that Nvidia was at, several weeks ago at this point, right? And so they moved higher, and they've been held, I think, by this call gamma that was kind of a negative gamma position, and now we're just sort of pinning, and we're going to remove all that. And I think that leads to a little bit of consolidation. But to your point before, any consolidation here, I think, is just an opportunity. Hey, I missed this stock before. I'm not going to miss it on the second time, right? Like, I think that you're going to get the dip buying before you get the sort of the long term, the long term sellers.
Because you got like Stanley Druckenmiller buying it, and he's not buying it for like a short-term trade, right? He
Right,
wants to sit on it forever. So that the idea is like that thesis, that long-term thesis, is going to be adopted by pretty much everyone at some point, right? It's just that markets have all jumped on it pretty quickly on the last earnings. That was
and the call positions. I mean, you can always just buy the stock, of course, but the calls are just got to be ridiculously expensive, right? And I think that's the problem when these things start to chase, is that a lot of people, can buy the call. They can be correct in that the stock continues to go up, but they lose money because they're just paying too much for that upside. And that I think is where it gets tricky, is that even in the IWM, like you said before, like that call skew, it's flat, right? But flat for an index is quite expensive, right? And relative to historical terms. And so, you see this demand come in, you see record IWM volume, record Nvidia volume, record, call positions across the board. And that chase just makes these call options all very expensive, which in my view, incentivizes those call sellers to come in and kind of slow the whole rally down. And so, I think timing your entry is really critical here, particularly for an options trader, because you could end up just paying a lot and losing, even if directionally you end up being right.
Yeah, and I'd say now that you've kind of had the real parabolic bit of the move, at least in the near term, if you are playing for upside, you're probably better off using cool structures, right? Like cool flies, cool spreads, whatever. Right? You don't necessarily want to pay up for that silly amount of vol. Even on the downside, like if you're playing a correction on Nvidia, it's trading at 407. If you think it corrects back into like the mid 300s, I would do some sort of put condor probably, right, to play that, just because the vol is high on this thing. Those tend to be the better risk reward ways to play these like really pumped up single names, right?
Yeah, because if it's stock up, vol up, then when the stock goes down, that vol's going to come down, and I think that's a tricky spot to that newer traders, I think, probably get tripped up in a lot of times. Like, I'm going to bet that the stock's going to go down. I'm going to buy these puts, and then the stock goes down, and your put loses money. It's this hidden tax, right? And we try to talk about that a lot. And I think those put flies can be very interesting ways to play these names.
Yeah, something like, yeah, exactly. I think I can't remember if I pitched one like a couple of weeks ago or not, but they are, that's the thing. Like when options get really expensive, you can still find good risk reward trades. You just have to do multi-leg option trades, which can be scary for some people, but with some basic education, like they're not that hard to understand.
Yeah. And on this kind of point, I mean, the velocity which all these names, moved higher, as you can see here from May up to, really where we are now. I mean, those are tremendous moves across the board in all of these stocks, right? And they really have, these moves by and large have stalled. Like the intraday vol can be, pretty decent, I guess, and obviously, but they've really gone nowhere over the last, week or two, maybe even 3 weeks. And I think a lot of that is because these big gamma positions have come in. And I think there's a lot of dynamic hedging, be it, vol traders that are coming in because that vol got rich, or dealers, or whomever it may be, right? This gamma has all grown at these in these names at these prices, and it's largely held these prices in check. I mean, you can see it. And I'm always fascinated when you get these situations where you have just so much energy driving these stocks higher, and then they just stop, and then they pin, right? That to me is always the interesting part, right? I think a lot of us would expect, hey, let's see a lot more mean reversion here, but you're not getting it. You're getting like this pin. And I think a lot of times that has to do with dynamic hedging, which comes in to hold these names around these large gamma strikes. And again, it's probably the third time I've said it now. A lot of these positions are going to be removed. So, the first order effect of this is going to be, I think, a lot of volatility coming out of this. I think it's going to be a little bit of a pullback first, but ultimately, we're likely to shift higher.
Yeah. I think you're making me want to do a put condor for like the next couple of weeks.
But you can see it. I mean, it's a fascinating thing that you can get this much. I mean, you look at these last rallies, right? In March, we rallied and rejected and came down. Same thing here, June. You can see this, these V shapes here. But this is this seems to be a little bit of a different thing, right? It seems to be more of a rip and pin as opposed to that kind of mean reversion trade as things come back. And on this point too, this pause in a lot of these names has given a lot of opportunity for the relative performance between the Qs certainly and the S&P to come back. I mean, the S&P here is in gold, and Qs, which had been really outperforming, that performance gap has closed a little bit. And I think that's ultimately healthy for the market. I think it's healthy when the small caps catch a bid. I think it's healthy when it's not just, 5 names, leading this huge rally.
Yep. More broad based. You definitely need to see a more broad based rally. Agreed.
Yeah. So, as we shift forward here a few more days, right? We have FOMC obviously tomorrow, and then we have this buyback blackout. I don't know if you've done any work on the buyback periods, the blackout periods. It's pretty large flow, right? We're going to lose that on the 15th as well. And then we hit VIX options expiration. Do you think that there's any effect from VIX OPEX hitting, next week along with this buyback period? I mean, do you think we're going to get any kind of material weakness? Is it just a real mild correction in your view, or we're just going to kind of plow through it? Do you have a view there?
My hunch I was looking at the VIX open interest for June, and there's quite a lot of, it's just 15 strike and above, right? There's a lot of open interest on it all the way up to like 25 plus. So I thought in general, I think clients buy that stuff and dealers sell it, right? So I think given that VIX has kind of overshot all the way through pretty much the entire set of strikes, I think the charm effect, if dealers are short that upside, the charm impact into the 21st of June, which is next Wednesday, will be a net sell of VIX, basically, right? I think that will keep pressure.
Yeah.
I think that will keep pressure on the VIX into next Wednesday. But then once that goes, then maybe the VIX has a chance to then have a bit of an uplift. But yeah, so that's the sense I get from just making the assumption that the majority of those strikes would be dealers short, clients long.
Yeah, and I agree with you on that one. The interesting one as we talk about that move forward and is of course this JP Morgan collar trade, which has just become this this thing that everybody focuses on. And it was actually, it's kind of interesting. I went back in time and I looked at, how the market reacts around this thing. And it's really, we pinned one of the levels, not in the previous expiration was at March, but in December, we kind of pinged that level. And then at last expiration, March, we were well below, the strike was 44.60, I believe, or 44.65. We were like 2% below that the day before, and we just kind of rallied and ripped right through it. At the moment, we're at 43.20, right? Is that strike?
Yeah.
And we're obviously quite a bit, over at the moment. Is there still, we got 2 weeks ahead of time here, right? For this strike to hit. Is there enough of a position there, do you think, to kind of pull us back down? At what point would you just mark it and say, look, that position is no longer in play? Is it over 4,400? What's sort of your, at what point do you sort of say, hey, this still matters versus like, okay, like,
yeah, I think you just got to see
we're too far away from that strike.
I think you got to see how much delta's on the option, on the out of the money option, right? So, if that put is a 30th of June put, 43.20 put is a 30 delta put, then it still matters. If it's like a 5 or 10 delta put, maybe it doesn't really matter anymore, right? So I think it's kind of that, like, as long as the delta of that option is 30%, the out of the money option. So the put in this case, if it's 30% or more, it's going to have some impact because it's going to have quite a bit of gamma on it, basically, right? Once it becomes 5 or 10 delta, because you've moved, either time has passed or you've moved too far away from it, then I don't think it's going to do a lot, right? That's how I tend to think about it.
Yeah. And I mean, there's still so much time between now and
there's plenty of time to trade back down
in that moment, and it's such a heavily watched trade. I mean, we just were talking to this old friend of mine, Tom Jark, who he ran the derivatives bank at.
I know.
Oh, is that right?
Yeah, I
we're just talking to him.
Yeah, I overlapped with him at various banks, Credit Suisse, Citibank as well, I think. Yeah.
He brought up when we had this clip on our YouTube thing, and it was just like this, it's one of those things and it's just refreshing. We says like when we have a trade on, or we had a trade, and everybody on the street, knows what's coming. Everyone knows this is the position. Everyone knows the strike. Everyone knows we got to roll. Everyone knows we got to hedge. You can turn that to your advantage, right? And I think you could structure how you put the trade on or adjust around that, right? To almost use the fact that everyone's focusing on this thing, against it, right? Against itself, or turn the market on itself, right?
So it's like game.
And I think that's what makes predicting.
You're talking about game theory.
Sorry, say that again.
You're talking about game.
Yeah, game theory, exactly.
Yeah. Okay. Yeah.
Yeah,
it's true.
And I think that's why wouldn't you do that in this situation when everyone knows it's coming? I mean, I think it's in your fiduciary interest on behalf of your client, right? As the dealer there to do something like that. And it makes kind of it more of a fool's errand of attempting to figure out, at least on the day, exactly what's going to happen. You know what I mean?
Yeah. It's hard.
So, I think the more the attention sort of focuses on it, it's kind of like that elevating call implied volatility, right? The higher implied vol goes up, the less the stock is likely to go up. The more you focus on the JP Morgan trade and everyone focuses on it, probably, the less you can actually track what the heck's going to happen.
Yeah, exactly. And remember, the options, whilst they do play quite a big factor these days because the open interest and the notionals are getting so big, there are other flows in the market moving things around, right? So, we have a tendency to want to explain everything just due to the options complex. You can't really do that, right? It's just one part of it's just one part of the mix, really, right? I think some people
and particularly. I didn't mean to interrupt you there. So particularly on the quarter end, right? It's a quarter end. Obviously they're coming off the back of this FOMC and a lot of those flows. So that just sort of backs your point there. K Kumar here asked about the XLF. That's not something I track terribly closely. You have any feelings here on the XLF around the FOMC and just kind of these bank stocks in general?
No, I mean, look, I think KRE is a slot at some point. I don't know. I don't have a stronger view on XLF as I do on KRE. I think these regional banks are going to be a bit basket casey. I think until the yield curve normalizes and the Fed starts seriously cutting, these banks have got an issue. It seems to be a relatively slow motion issue, but it's not about to disappear and go away. So I do, I would be looking to get into downside structures in KRE at some point, but right now they're in squeeze mode, as are all the beaten up stocks. So stay out of the way, wait for the market to show its hand, and then it's done squeezing, and then maybe look to some downside again. Probably put spreads or something on KRE at some stage, right?
Yeah, I'm gonna stand aside from anything on the individual regional banks. No one needs to hear my analysis on that. But just looking at this XLF chart, in particular, I mean, that looks like, if anything, it's poised for kind of a breakout. But with the Fed tomorrow, who knows how that could turn. It does seem like the JP Morgans of the world and those banks are doing a little bit better. I mean, Goldman, I think just hit recent lows, but it's bouncing pretty solidly here. But when you look at a lot of those regional banks, I do think you got to kind of dig in and figure out what the exposure is, and that's a little more of a fundamental guy's game at this point. This just does not want to seem to catch a bid, which to me just signals that there's a lot of issues under the hood right? Because this is a market that wants to buy the dip aggressively, I think now, and KRE just can't seem to manifest a bounce.
Yeah, it's hard to sell it.
It-
It's hard to sell it at this level, but you know, it could probably, I could see it popping back to 50, 52 at a push.
Yeah.
But then I'd be quite comfortable putting some put spreads on, to be honest.
Yeah. And the other issue too was like the implied vol on so many of those banks, kind of the point we were talking about, to the downside was just getting, really pretty crazy. And so it almost stopped you from being able to buy a put profitably, even if you were correct, right? And then I think, I don't know what the short lending market looked like in a lot of those names too. Like there's just a lot of this, people looking to play and put pressure on a lot of these names, and it just got, I think a lot of times just got a little too rich. So we'll see. I know hotels are defaulting and everything else. We'll have to see what the impacts of those are. I know in a few minutes here we're going to transition to doing some structuring and talking about maybe some educational stuff around our series called The Hedge. For those of you who don't know, Imran is the handsome face of our academy here, academy.spotgamma.com. We think it's a great course, so we recommend that everyone stop over if you're looking to just brush options knowledge. If you need to start from, hey, what's a call and put? Not that most of you watching here, of course, know all of this already. Sometimes it's good to backfill or just get that refresher. But check out The Hedge. We walk you all the way through the basics, all the way up to sort of advanced gamma hedging and delta hedging strategies. It's really a wonderful course. So we're going to take a couple questions if anyone has them on trade structures or other general market concepts. We always pause at the end of these quarterly discussions to have some of these or to pause for Q&A. So if you have anything, please put them in. I wanted to start with one here, Imran. I've been looking at Target, which, I know you're sitting over in the UK, so politics aside on this one, I don't want to wade into the politics. I have zero opinion on any of this. This is kind of a hornet's nest. Fortunately, in the finance game, we often put politics aside if we think that there's money to be made, which is a dirty truth, I think, of the finance industry. This is a name that has just been getting smoked, right? And again, I don't want to talk about why. I'm just talking about the price action. This is down, 20 some odd percent in a few weeks. We're talking about a lot of names, and we're going to discuss this tomorrow. We're talking about a lot of names that have a lot of big call positions, right? This is a name that has some big put positions. I'm going to cover this a little bit in an OPEX detail that we have tomorrow. But let's just say that we know that Target here has been getting beat up real bad. It has very high implied volatility. How would you look to play or structure a rally here? If you want to set that up, if you thought that it would rally around OPEX.
What's the time frame for the rally?
I think it's an OPEX-driven, a rally. So, let's say 1 month kind of is my maximum view on that trade. What are some of the ideas that you would look at in that scenario?
Into July expiry, so into the 21st of July, basically, something like that.
Right.
Yeah.
Right.
Yeah. So, a couple of ways I look at this, right? So, when you've had a stock getting beaten up, usually the volatility has risen. Okay. So just buying outright calls, whilst it could work, the hurdle's quite high, right? Because even if you get the delta right, through the passage of time and through the implied vol probably resetting lower, the delta's got to do a lot of the work, right? It's really got to bounce. It's got to bounce fast for you to make money off the call option. Okay. So I don't generally tend to gravitate towards naked calls when you've had this type of dump in the stock and a rise in vol. So then what are your alternatives, right? I would say there's three main alternatives. There's outright call spreads. So that's the simplest one, probably, where you just buy a call and sell a call behind it to have something that still looks like a decent risk reward, maybe 4-1 if you max out, but the time decay bleed won't be too fast. The Vega exposure will be kept in check because you're not just buying an outright option. Okay, so that's one way of doing it. So with target here at 129, maybe something like the 140, 150 call spread. That's a 10-point wide. What would that cost? I don't know if you got those options chained in front of you there, but we could see what that is. Then your next option would be, okay, it's still not giving me a risk reward that's attractive enough. Giving me like 2-1. I don't like it. What can I do? So then your next option is something like a call condor or a call butterfly. So that would be where you buy one call, you sell two calls, either the same strike or two different strikes, and you buy one call at the end just to make sure you don't get into trouble. That's a net short Vega trade. So that will actually benefit from the fact that vols are more expensive. It'll give you a reasonable risk reward, but it just won't be that easy to monetize straight away if the market suddenly rips in the next week, basically. So if you're totally right about OPEX, we go through expiry and then we find ourselves up 5 to 10% next week. If you'd done the call spread, you would have made more money quicker. Are you still there?
Yes. Yep.
Yeah,
So
okay.
sorry.
That's right. You would have made more money faster on the call spread, whereas the call fly or the call condor will not only require a rally, but it will need the passage of time for it to make its money, right? So that's kind of the difference. You're trading off some of your delta for theta that you're going to earn if we rally, but you're going to have to wait for that money to get closer to July to make that trade, right? So those are your two. And then the last, even more complex option, which you can learn about all of these structures in the hedge course, but the more complex option is something like a call calendar. So what you can say to yourself, you still with me, Brent? You disappeared again.
Or still here. I'm grabbing a charger. Sorry.
Okay, no worries. I didn't know if you dropped off or if you just went off the screen. And the call calendar, that is more of, again, that's very much a timing play. And you're taking advantage of not only an increase in vol, but you're taking advantage of an inversion in the term structure where short dated options have got really, really expensive and slightly longer term options aren't as expensive. So something like a 2-week option might trade on a, I don't know, 80 vol, but a 6-week option might trade on a 60 vol. Okay. So you might say, well, I'm pretty confident we're not going to breach 140 in the next 2 weeks. But so I'll sell the 140 call that expires in 2 weeks, and that's giving me a juicy premium. And then I'll buy something like the 150 call that expires in 6 weeks. And I've essentially bought an outright July call, but I've cheapened it up by selling a 2-week call in front of it that I'm quite confident isn't going to get in the money, basically, right? So these are the ways you can structure various types of call structures to take advantage of those higher vol conditions.
Yeah, and that's a beautiful response. And the key to your whole point is that you don't want to overpay for that implied volatility because it is a toll, right? Even if you're betting on that rally. And so structuring, using spreads, kind of that point you brought up earlier, using spreads and multi-leg trades to help offset that IV drag, right? If the stock does rally is really critical. So great answer there. Thanks for that, Imran. Florida Boomer here says 4,300 strike is the huge strike in the S&P for puts and calls. How do we see the market unwind? Is it rally or dump? We talked about this a little bit before, but it did, bring up another interesting opportunity to talk about a possible trade at this point. Do you think, this 4,300 level here is the one that Mr. Florida Boomer there, assuming it's a man, I shouldn't do that, Florida Boomer is talking about? Is there a clean structure that you like to look at if you wanted to play the market, kind of having this mean reversion? Is this a good opportunity for put flies, or do you just simply say, look, with an implied vol of 10, it's cheap enough for me to just buy a put here and let that be, right? I'm just gonna write it off. How do you make a difference in a decision making when you're saying, look, to play downside here, I need to play the put fly, or I'm just going to buy the outright put because it seems cheap? Is there a decision making kind of?
Yeah. So I mean, it's you look at the value of the outright option, and obviously the implied vol will play its part in making you decide whether that's cheap or expensive. You got to compare that implied vol to the realized vol as well. So right now, the implied vol is pretty cheap relative to realized, right? So there's not a lot of implied vol premium that you're paying.
Realized is about an 11 in the S&P right now.
Yeah, which is higher than the vol, right? But the money vol. So that means vols are cheap in general. Also, skew is cheap in general because it's been flattening dramatically. If you look at various skew measures like the SDEX or whatever, So you know that owning outright puts is cheap, but the problem is it can look cheap, but you might not want to buy it still because you might not have very strong conviction that we're actually going to sell off, right? So it's not just a function of whether it's cheap or not. It needs to also be a function of your view and your conviction level, right? Because you might be like, it's cheap, but I don't really think it's going down there. So I'm not willing to commit outright premium that is going to decay to you know, because but if I structure something like a put ladder or something, because like for example, if we expire here or above 4,400 this week, and we think there's a reasonable chance that we're going to drift back to that 43.20 area for end of June, then I think the optimal structure will be something like a put ladder where you go long the 43.50 put, short the 43 and short the 42.50, right? And that will cost you next to nothing, right? And you'll get basically P&L between 43.50 and 42.50, basically, right? Which is a 100-point range where you'll make some money, and you spent no money, you spent nothing or close to zero for that, because that is nice because you don't have to have such strong conviction the market's going to sell off. But what you've got strong conviction about is if the market sells off, there's this monster amount of gamma that's going to hold the market near 4,300, right? So for me, that's how I think about it. You need to screen everything systematically to understand if vol is cheap or expensive relative to realized, relative to its own history, and all these things. But then you've got to layer on the most important thing, which is what your bloody views. What do you think the market's going to do?
Yeah.
And what's your conviction? What's the conviction level you have against that view? And it needs to be based on more than just volatility analysis. It needs to be based on macro. It needs to be based on charts. It needs to be based on every framework you use to construct your view and get your conviction. You got to get the options trade to align with that, right? That's what I think.
Yeah, I would say, I think that in this case, with a lot of this position, right, 30-something% of this position, the S&P is going to go away on Friday. So a lot of the bars we're looking at here, right, they're going to be dropped significantly in size. You're still going to have the 34.20 kind of JP Morgan position sitting there. And I think sometimes, at least I've found this in my own trading, I try to get too cute in certain circumstances, right? And I found that I'm better off to scale the size down and just buy what I think is a cheap option rather than trying to put on a put fly to bet on a pin, because of the blah, blah, blah. And just saying, look, I think fall may be cheap. I have these reasons for the market to go down. And so, my conviction is super high. I'll pay a little bit more for that. But, there are these times when implied vol is very high. And you could just tell that by looking at, skew or whatever the other, volatility metrics are. And you could tell, no doubt, like we'll all be in consensus, right? Implied vol is very high in these names. Doesn't mean it can't go higher, but you know you need to offset some of that cost when you're putting on your trade. In these other situations, yes, realize that it's at 11 or a 12, and the option I'm buying is probably at 11 or a 12. And so from that perspective, okay, the puts are a little expensive, could be, but the everything is priced for perfection, right? We're trading at, implied vol of 8 to 10 is a 50 basis point move on a daily basis. If I think something's going to fall apart, all of these short people are going to get caught off sides and have to cover to the downside. That's going to exacerbate volatility. And so some of these structures are actually going to hurt my P&L or whatever I can make to the downside, right? And so, again, it's totally to your point of do you think is going to happen, and what are you pricing for? And I think in these situations, specifically with Florida Boom here saying 4,300, like, that's the level I want to play for. If you think it's going to pin there, then you'll get a little bit of a cheaper trade if you put on the spread or the condor, or whatever it is that you want to do, the fly, I guess it is in this case, right? But sometimes I just found, like, hey, make your bed, buy the option, spend what you're comfortable losing, and know that some of these factors, like implied volatility going sharply the other way, which is quite possible in this scenario, could pay off just a lot better, right? And I think sometimes you want to call it not really like a lotto trade, right? I think in this case it just seems cheap. It seems like everyone's kind of debating on That was a long diatribe there. I know, Imran.
No, so
Um,
what I would respond to you, what you said, and it makes sense what you're saying, but it's a function of the trader's style, right? So
mhm,
if your trading style is, I want to just, I don't want to have to manage it. I don't want to have to manage it in real time. And if the market looks ugly, I'm going to have to do something. I'm going to have to hedge it or unwind it or stop out or what mitigating
yeah,
trade. I just want something that I know can't fucking hurt me and can give me good leverage and make me some money. Then you're going to generally be an option buyer. And like you say, whether the option is
yes,
10 volt, 11 volt, or 12 volt, you don't give a shit because it's not 30 volt, right? So
right,
it's cheap,
exactly,
right? But systematically doing that all the time is a losing game. So for people
100%.
so for people who want to trade options regularly and trade a lot and make a living out of it, you have to find ways to fund stuff. You have to be comfortable being short options and knowing how to manage those options, knowing how to identify conditions in the market that favor being short options, so that you're not suddenly going to get into this really fragile position that can blow you up, right? And a lot of the time, low vol should actually make you feel more confident selling options. When options trade expensive, it's because every man and their dog is fucking short them, right?
Hmm.
When options trade cheap, it's because everyone fucking owns them, right?
Yeah,
So once you get that, you realize that this market isn't about to roll over 10% in a day because everyone's got too much optionality down there, right? And so, and it's only through doing this time and time again and understanding those dynamics. Yes, they can change. Yes, something can happen and some big couple of buyers come out and take the whole street out of Gamma and the position flips. But that's what people like you are there to show us, right? Because your hero indicator will see those flows and we'll see that, oh shit, suddenly 100, 200,000 puts have traded in the last 24 hours. Someone thinks the game is changing. Yeah. And if you're watching
yeah,
that, then you can reevaluate and risk manage accordingly. Right. But the
yeah,
cheap, the cheap vol and skew is telling you the street owns that stuff. Yeah.
yeah, yeah. And so I think this is the thing, right? I think you and I both feel like we're going from the risk of the market here is that everything is too rich. The calls are too rich. We need to like chill for a minute, right? And like chill for a minute to get some consolidation, and then we can kind of like try again. I think it's very hard to go from like calls are expensive here to all of a sudden like we all got to buy puts because the market's going to crash real hard. I think the first order reaction is for people to want to buy the dip. Right, I missed the rally. Now the calls have gotten cheaper because the markets come down, balls come off, and we can try to kind of buy that. Buy in where we missed before. I'm trying to read the question again. Is if puts expire on Friday and the dealer's going to buy back those short stocks, do we see a Monday rally? I think I feel like we have a bunch of reasons for the market to consolidate here. And when I say consolidate, give back a few percent. Admittedly, I felt like that heading into this week, and we've already gained, I gained a percent between yesterday and today, right? So, it's there's some path dependency to where we're going to start with kind of a sell off here. But I do think we're probably going to hit 4,300 if I had to guess. We're going to test that level again sometime before the end of the month would be where I'm kind of putting my money. And I generally hold long spiders my personal account, and I love selling calls against that. That's generally what I'm doing. And I like just owning those spiders because that's giving me long delta, and I think the market is just generally going to rally. So the conundrums I generally have, kind of to Imran's point earlier, is when do I want to hedge that, or do I want to take that exposure down or off, or what do I like to do? And I think sometimes in these situations, like right now around OPEX, I have on a collar trade myself. Is how I'm choosing to express it. So I still like being long. I still like to buy the dip, but I do have on a collar trade in this case,
Which
trying to
expiry?
take advantage.
Which
I'm
which
at end of June, so yeah, end of June. I'm short the 40. I'm short the 440 calls against long. I think 420 put or something like that.
yeah. So I
And
do
I've written that off as like a tax, right? I may have to roll that higher, as we approach that strike. And sometimes what I've actually been taking and doing is trading the XSPs, the SIBO index minis, against that spider position, because then it just settles in cash. I don't have to worry about my spies getting called away, which is one of the things I kind of like want to mitigate or eliminate. But in these situations where I just feel like the market has this bullish trend, I just prefer owning that spider because I know I got that long delta piece covered, and then I can manage, around that a little bit separately.
Yeah, so you're doing something
But
similar. You're doing something similar to what I do. So I do this joint venture product with Darius Dale of 42 Macro, where he's got his portfolio construction, and then I show him how to hedge with that. So we did something similar where a week ago we bought some September puts against, he was long quite a bit of S&P. So we bought some puts with the view that we were going to collar it, but we just didn't want to collar it straight away because we thought there was some squeeze potential, right? So we're like, you know what? The market positioning was suggesting to me that exactly what's happened could happen, that we could squeeze and see vol go bid with the market for a week or two. And then we were like, so let's just buy the puts now because they're in the book, knowing that we're going to sell the calls, but we're not going to sell them here. We're going to let the market rally, or we're going to give it 2 weeks to rally. If it hasn't rallied, we'll sell the calls anyway, and we'll just take whatever. But if it rallies, then we get to sell an even higher strike call and get the same premium for it. And literally today, we just executed one of those short calls, and that worked out quite well. That's called legging into your hedge.
That's a beautiful way to do it. So many different ways to express these different trades, and I like also owning those spiders as just it's an asset in my view that I can sell short dated options against, right? So I'm generally selling calls on a daily basis, trying to roll those up and shift them around. I mean, I just literally use all the tools that we have at SpotGamma. So there's and this is stuff I talk about on a daily basis. But kind of to your point before, I just feel like the reason I'm doing this is because it feels like that those calls are a little bit rich to me. Vol's a little bit cheap. I see these catalysts coming up, and again, because I own that long delta, if I'm wrong, it's a tax that I paid, right? Possibly if I have to roll this call higher, take a little bit of a lump there. But that's what insurance is, right? In some of these cases, and so I think for me, I can just put that trade on, know that I got the downside here, somewhat hedged if I'm wrong. So be it. I kind of paid that tax. So interesting that we. Sorry, say that again.
Someone's asked, how would you play institutional performance chasing FOMO? Any thoughts on that?
There are clearly stocks out there that, there's the sector that everybody knows about. That's the AI sector. I think the question is sort of like, what's the second tier technology stocks? There's a lot of people like on Twitter and elsewhere that kind of name those names or do the more fundamental side of those things. And so I think that our call over the last couple of weeks, we read our notes, was like we thought that the S&P would close its performance gap to the Qs. I think that's happened because a lot of pinning in this case. I think IWM, the calls are a little bit rich here, but you can see that catching up a little more. But I think there are these second tier kind of technology names that will pick up in performance quite a bit. And I think people want to move to that second tier trade, right? Like these other names that are due to catch up to the leaders. And I think that is where.
Have you seen Tesla recently? Have you watched Tesla?
Yeah, Tesla's been. I mean, it's been amazing the rally there. The interesting thing for us in Tesla was the positions by and large stalled. You talk about a very clean looking catch up name. It is the famous stock of all the meme traders, right? Like that, it's the original meme stock in a lot of ways.
Why don't you walk us through what your tools say about Tesla right now? Because I'd be curious to know that.
Yeah, so we've talked about this in some of our Q&As recently, and what's interesting to me about Tesla is if you look at where all the positions came in, you could see just over the last 10 days here on the screen. Key gamma strike was at 200, and you could see this key gamma strike continue to ladder higher. And the same thing with the call wall. The call wall continued to ladder higher. And so what this was telling us is that people continue to come in and they are putting call positions in at higher and higher strikes, right? So we're continuing to ladder up, which in general is just a very simple first case analysis is bullish, right? Anytime you see calls coming in at higher strikes, that is supportive of the name. And if the stock was to come down, now you have these positions that exist below that I think are supportive. Now, what was interesting is if you look back a week ago, and again, we did a Q&A video on this, at 250 at the time, there was no positions over, and that's our current call wall here, right? There was no positions that existed over that. But now what we're seeing is there is very big positioning coming in now to 300, and some of these strikes that are kind of higher. So Tesla's about to lose, 30% of its position, 21% of its deltas, and so again, I think that could cause a little bit of pullback in the name starting early next week. But the fact of the matter is that there are a lot of positions above that are going to persist or exist after this option's expiration, and so I like buying the stock on weakness, and I do think that this 300 level is one that, particularly if the market retains its bullish stance, this is a stop to this kind of institutional point. This is how do you play catch up, right? This I think could be a name that could really catch up. It's a big component of the S&P 500. It's a name that I think if you own as an institutional manager, you don't have to explain why you own it necessarily, right? It's not kind of a lower tier stock that doesn't make a lot of sense. This is a kind of a plus it's a name that just it loves to get squeezed, right? And so it makes a lot of sense to play catch up using that.
It's quite a decent weighting in the ARK basket, basically, right? I don't know if it's.
They just sold some, I think.
Did they sell some? Okay.
I believe they just sold some, and this was like yesterday. I think I saw a headline on that.
Yeah. Because
I'm looking at my.
I think part of because the ARK performance has been pretty good.
Yeah, she sold a bunch of Tesla shares yesterday. Yeah, so she sold out Nvidia right before it popped, and then they sold. I mean, Tesla's had a great run, so I don't know, who knows, but
yeah.
that ARK basket is those funds are an enigma to me. They get so much coverage, media coverage and the like, and just I don't quite understand it.
So we flagged like an interesting structure on the ARK basket a while ago, where before ARK really started to motor.
Yes, in the last in our last commentary, we were talking about that, and stocks done well.
That's done well, right? It was like the 45.50 1 by 3 back call ratio.
Here's May OPEX. May OPEX is right here. Stocks at 38, so we're up a good 10%, and
so that thing's done well. It was zero cost or close to zero cost. It's made some money. I've had some on. I'm thinking of taking them off now just because we've had such a nice run. And I think the Nasdaq, a target of 15,000 on Nasdaq as well is a bit of a target. So I think they've definitely got room to consolidate. I don't think they're going to fall out of bed though, right? For the reasons I mentioned. But taking some chips. If you've got premium that's going to decay, if you've got those sort of chips on the table, maybe taking some off does make sense, right?
Yeah, I totally agree with you. I think that's you and I are on the same path here in terms of looking for some consolidation, not like a bear market contraction at this point. And I think that the dips will get bought at first here. So and they definitely sold. I think they sold yesterday. So, Imran, we're coming up now to the top of the hour. Obviously, the Academy is one that we want to recommend to people. If you're looking to catch up on some of these terms, fixed strike vol, gamma hedging, all those kinds of things, the Hedge is a great course to start with that. Where else can people find you? You got your Twitter. You got a lot of great things going on.
Yeah, I put my stuff on Twitter. I've got a YouTube channel, Options Insight. I've got my Twitter, Options_Insight. Speaking of fixed strike vol, I did put a tweet out earlier today with my fixed strike vol monitor showing what happened to S&P fixed strike surface yesterday, and I made my comments around that, like what I think that implies for gamma positioning for dealers and stuff like that. So that's something I'm monitoring pretty closely on a daily basis. If you scroll down a little bit, there's that chart there. That's my fixed strike vol monitor that I run on the S&P. I also run it on other field if I need to, but in general, it's part of my weekly report. Just keeping an eye on what fixed strike surface is doing and what that means, if anything. That doesn't always mean something to the market. That's the point. Like, the idea about systematically monitoring options markets is just so that you're observing, right? You're not always going to have such an exciting, interesting insight from it. But if you look at it every day, you start to notice when there are interesting insights. And that's why we do it, right? That's the whole point, right?
Yeah, 100%. You need to have relative, a basis for understanding, which is sort of like you need to have a realized vol metric to clear to implied vol. I reminded of one thing, so we're gonna do an extended hours thing. I don't know who this fella is, Carlos. I mean, I saw this morning, and I was just staggered at number one, the loss. Number two, I'm just chilling. Number three, and I gotta have to do a video on this later. This is the weirdest hodgepodge of positions I've ever seen, and I feel like I almost gotta like try to reach out to this guy just to be like, what is going on, man? I mean, this is, what do you even say about that? It's staggering, right?
It's amazing. I mean, if he's that relaxed about losing $500,000, he must be pretty fucking rich.
I don't know. Well, it was funny because I was talking about this with someone as JP Morgan said they took on average one client a day last year in the wealth division that had one family a day that had a net worth of $100 million, and they have 700 families that have a combined net worth of 3.5 trillion. So this guy could be one of those people, and he literally just does not care about $500,000.
You should get him to join the hedge. We can turn those reds into
he needs the hedge. That's for sure.
Greens, mate. That's what we're doing.
These aren't even spreads. They're just it's like, what do you? But the point of me bringing this up is to get out of this hole. He literally needs God forbid, like a nuke to go off at this point, because that's even just to get his money back. I mean, some of these strikes are very low. The bleed on these things are going out. It's just
yeah, I mean, it's just a real scattergun. It's a scattergun approach to buying puts. That's all it is. It's just
and that's the part of me that doesn't make any sense. There's no structure to it. It's just it's just layering in, tens of thousands of dollars more of puts. Maybe he's got a $10 million equity long, that's making him money. So, at any rate, that was a complete total offsides here. But Imran, I want to thank you very much, and I want to thank everybody here for putting up with me being a couple minutes late. Sorry for those connectivity issues. I'm going to be back doing a couple of hot takes on some big OPEX stocks. Maybe I'll shave my beard. I'll come with a different approach. Fresh face, baby Jesus tomorrow for the call. But Imran, as always, thank you very much for your time today. You can catch Imran at Options Insight on Twitter, so please go check him out there. If you have any questions, info@spotgamma.com, or you can hit me up at SpotGamma on Twitter, and we'll be happy to get back to you. So thanks again, everybody, and we'll see you